As 2025 comes to an end, global markets confirm a late-cycle environment characterized by slowing growth, easing inflation, and a gradual shift toward more supportive monetary policy. Full-year global growth closed at approximately 2.9%. Manufacturing and global trade remained weak through year-end, while the services sector continued to provide stability and prevent a broader economic downturn. Inflation declined steadily across regions, allowing central banks to pivot away from restrictive policy without triggering financial stress. Overall, 2025 ends with softer momentum, but without recessionary dynamics. By the end of December, the U.S. economy had clearly cooled but remained resilient. Consumer spending moderated, labor markets softened with slower job creation, and corporate investment remained cautious amid trade uncertainty and political risk. Core PCE inflation closed the year near 2.5 to 2.6%, enabling the Federal Reserve to deliver its first rate cut of the cycle, bringing policy rates to 4.00 to 4.25%. The Fed closed the year with a data-dependent stance, signaling flexibility heading into 2026. Strategic focus remains on quality, balance sheet strength, and liquidity. Eurozone growth finished 2025 close to stagnation. Wage growth supported consumption, but exports remained constrained by weak global demand. Inflation closed the year near target at around 2.2%, allowing the ECB to begin a cautious easing phase. Positioning favors defensive sectors with earnings visibility and pricing power. China closed 2025 with GDP growth of approximately 5.1 to 5.3%. Domestic consumption and targeted fiscal measures offset weak exports to the United States, while intra-Asian trade improved. Currency volatility persisted due to capital flow pressures and policy adjustments. Strategy remained selective, focused on structural growth areas. The UK ended 2025 underperforming peers. Growth remained below 1%, inflation eased to around 3.4%, and the Bank of England maintained a restrictive stance, pushing any rate cuts firmly into 2026. Entering 2026, a flexible, equity-centric allocation is appropriate. 65% equities focused on quality, cash flow resilience, and global diversification. 20% real assets including gold, commodities, and listed infrastructure. 15% cash to preserve optionality and capture volatility-driven opportunities. The closing message for 2025 is clear. Discipline, selectivity, and capital preservation remain essential as markets transition toward the next phase of the cycle.